Martin Zorn.
Yeah.
Hi, welcome. I'm Chris Lethem. This is The Economy and You. Today's guest is Martin Zorn. I wanted to say Marvin. I don't know why I thought Marvin, but it's Martin Zorn. Martin Zorn is from a company that does some pretty interesting work, a company called Kamakura. Now, Kamakura sounds Japanese.
It is.
Is it? It is Japanese. Oh, okay. All right. Okay. I'm going to take my glasses off here because I had to do some reading earlier. You have been around in Hawaii for how long now, Mark?
We've been here we're going on our 15th year here in Hawaii.
Year. Okay. And what made you decide to come and move to Hawaii and set up shop?
Well, actually, the company moved here from Japan, and the impetus of it was twofold. One, Don Van Devender, who was our founder, was with Lehman Brothers, started the company down in Kamakura, hence the name.
Okay.
And we had a very, very successful company in Asia. And to grow and be a global company, really, we needed to be back in the United States or in one of the large money centers like London.
Right.
And most of the people that worked for the company had spent time in New York and London and didn't want to go back to New York or London. And
it's a little expensive.
Exactly.
In either place, yeah.
And Don did an extensive search on different places to locate. He grew up in Southern California, so LA, San Francisco, the West Coast would have made sense. But back in those days is when Act 221 first passed. And because of the incentive for a technology company being Hawaii, this made a lot of sense, especially given the fact that at the time, most of our clients were in Asia. So with the time zone, it was perfect.
So it was sort of a nice East meets West opportunity. Plus, you were able to take advantage of Act 221.
Exactly.
Okay. Okay. Now, so Kamakura has its origins in the securities industry.
Correct. When the company first was founded, what Don had seen is that interest sensitivity, in particular, asset liability management, was something that was growing here in the United States, but it was really new in Asia. And what you had at the time was you had different software companies doing asset liability management, liquidity management, interest rate management, market management, credit management. And our head of development, who's still with us today, Kenji Amai, in a good Japanese engineering fashion, analyzed it and said, you know, Don, if you build all of these separate functions, 60% of the code is basically rewritten. So that's how we became the first integrated provider of all of those services.
I see. So you basically, do you refer to yourself as a software company then, who works in the sort of finance field?
Yeah, quite often what we describe ourselves as a software company that specializes in risk management.
Okay, all right. Now, risk management is, of course, that's a very broad statement. A statement that broad, of course, could you define that just a little bit more?
Sure. I would define it really as financial risk management and would break that down into really 4 principal components.
Okay.
So it would be interest rate risk management. So as interest rates go up and down, the value of your bonds go up and down.
Right.
If you have a portfolio of mortgages, prepayments on a mortgage will go up and down. The extension risk of bonds, getting longer when interest rates fall, for example. So that's the interest rate risk aspect to it.
Okay.
Market risk is the value of those securities changing with different factors. The third part of risk management we're in is credit risk. So default risk is what is the likelihood that the obligor will be able to make the payment?
And this is so we don't have you're trying to protect companies or organizations from having another 2008, 2009 scenario debacle.
That's correct.
Okay, all right.
And then, the things that are related to it are, and so important here in the United States, is capital management.
Yes.
And overseas, it's more liquidity management.
Now, what's the difference?
So, coming from a banking background, we used to kid around and talk about the
bankers. Wait a minute, I got to hear that. Bankers kidding around. Yeah. Okay.
The risk of a bank failing is basically capital was a bullet in the gun and liquidity was a finger on the trigger.
Okay.
So capital is on the one hand, capital is the amount of equity you have to withstand losses, but liquidity is the ability to meet your current obligations.
Okay, very good. Okay, that's great. That's a great explanation. But I did like the part about bankers kidding around. Okay.
I did say I was a reformed banker.
Reformed banker, okay. Well, I came from the securities background. I worked as a broker, and then I went into money management, and so a lot of these issues are sort of things that, we talk to people about. When you're in the investment field, you talk to people, and of course, a lot of people who don't have a background in finance or investments, they're very leery of investing. And so if they do invest, like their retirement plans or their profit-sharing plan, they often invest at a very conservative level out of fear of risk or a fear of loss from their portfolio. Obviously, over a long term, that can have a real impact on the valuation or the growth of your portfolio. On the other hand, there are times when you do have a market debacle at an individual level or at a corporate level, that if you haven't prepared for it, it can be very problematic. So it sounds like with what you're doing as a software company, you've developed some products to help people use the software. It sounds like it's fairly complicated.
We have two basic lines of business.
Okay.
We have an integrated risk system, which is what I described to you, and that system is used by large money managers, large financial institutions, insurance companies, central bankers.
So when you're using this type of software, you're looking at interest rates, you're looking at valuations. Of course, one of the things that you learn when you start studying about investments, and we're sort of talking sort of at a basic level, is that there's an inverse relationship to interest rates to the valuation of bonds. The longer the duration of the bond, the more volatility it experiences based on interest rate fluctuation.
Correct.
Okay, so now if you have a portfolio of bonds, then I suppose that you've got long-term obligations or cash obligations that you need to meet. What you're doing is essentially helping people put together a portfolio that sort of has the maturities and durations that help to mitigate that fluctuation.
So our customers are the institutions, not individuals.
Right.
Although we have a second product line, which is default probabilities, and I'll get to that in a second. Because
Okay.
one of the ways that there's really three ways I would say that we're different from other companies that are in the business that we're in.
Okay.
One is when people are modeling investments or loans or any other financial instrument, what they typically will do is they'll take a look at history. And we do that as well. But the thing that we differentiate ourselves is that we use a simulation model. So it's not just a historical statistical model. So it's what's known as Monte Carlo simulation. So we will then produce what future possible events could be, which allows us to model things that may never have happened before.
Okay, so these are all what-if scenarios.
Correct.
Okay.
And we do hundreds of thousands of them very quickly on the computer.
On the computer, because it'd really take a long time to do it by hand.
Absolutely.
Yeah.
Then the second thing that we've done is that we basically believe that asset values rise and fall with macro factors. So when I say macro factors, I'm talking about things like oil prices, the foreign exchange, interest rates.
As we've been experiencing, of course, the dollar has been climbing against the other world currencies.
Absolutely.
So this is one of those scenarios that could have an impact on valuations.
That's exactly right. So, give you a personal example. In 1985, when I was with Wachovia Bank, I opened up an office in Dallas, Texas. Or as I like to say, I opened the office at $36 a barrel and watched oil prices go down to $8.
Yeah.
And the value of my home followed those oil prices.
Yeah, especially if you're living in Texas or Oklahoma at the time.
Exactly.
Yes.
And that got me convinced that, that macro factors, those things that happen, drive asset values. Don saw the same thing when he was in Japan. I mentioned the time period that we moved here. That was also the time period that the Nikkei crashed and home prices crashed. So if you think about our models that look at underlying asset values being driven by macro factors, That's one of the reasons our models were right in 2008.
So these are correlative analysis that you're doing.
It's
Causal,
correct.
cause and effect, but also correlative.
There's correlation. It's basically a logistical regression formula
Okay.
that basically takes a look at how all of these factors cause, say, a stock price to go up or down, and how cash flows go up and down. And similar that people have choices. If you take a mortgage,
Okay.
you have the choice on your mortgage whether you'll pay it or not, whether you'll prepay it or not.
Okay.
And those are factors that if you are valuing a mortgage bond, and as you said when you started, that a bond is just an obligation of future cash flows.
Right.
Unless somebody defaults and then those cash flows go away. So you need to
it's
model.
supposed to be a problem.
So you need to have a model that could predict that if you'll properly value it. Similarly, if interest rates go down and somebody refinances, then that higher paying mortgage will get prepaid and somebody will take out a new mortgage, and that will affect.
And of course, that has an impact on the valuation.
Exactly.
Whether it's current or future valuation.
That's exactly right.
Right. Okay. Because if you cash it in before maturity, or if you what's the word we want to use when you return a debt instrument in before its time?
So
I know there's a word for that, but when bonds are called.
Yep.
And then you basically the bond is then paid off. So then, okay, you got your money, but now you have to go out and buy a new instrument. If you want to borrow money, you continue to lend your money as an institution.
Yeah, that's exactly right. So that's the interest rate risk. That's the rollover risk.
Yeah, okay, rollover risk. That's the right term for that. Okay, all right.
So those are the types of things that we monitor.
Okay.
Our systems will help an institution monitor.
So you're talking about when you talk about investment houses and money managers,
Yep.
they use your software. What is the primary benefit that they derive when they're using, or what is their goal in using your software?
Sure. Well, there's a couple different reasons that people use it. So let's start with say a bank that's using it for interest sensitivity.
Okay.
When you think about a bank, is that a bank is primarily funding itself short term. So it's deposits, it's savings, it's CDs. And they lend the money out long term. So the risk that they have is if interest rates rise rapidly, that they have a set of investments and a set of loans that are generally fixed, where their cost of money would all of a sudden go up.
And of course, those assets are going to be undervalued compared to new issuances.
Correct. So that they need to be able to model all of the different, outcomes to know, will they be hurt? How badly will they be hurt? Will they have the liquidity? Will, if they don't raise deposits, especially today, one of the things that's different from the last time we had low interest rates is that deposits were all local. Today with the internet, you could live here in Hawaii and bank anywhere and simply move your money from your computer.
That is very true, and money, of course, has that mobility now. And so also banks have to consider if there is a change in interest rates, how much of those loans do they want to package and then maybe offload into the marketplace, and which ones they want to keep.
Well, that's another area that the banks want to keep their deposits. So that's one issue. Second issue is that if all of their funding is short term and their opportunities are longer term, it's whether they want to hold it on their balance sheet or sell it.
Yeah. So that's a tough decision for bankers. That's what they get paid the big bucks for.
Yep,
that's
correct.
Right. Well, this is Chris Lethem. We're going to go to commercial. The show is called The Economy and You, and we'll be right back. Thank you.
Aloha, my name is Paul Jackson, better known as PJ, and my local interest is in sports. I have my own sports radio show at KWAI AM 1080 that you can stream live. I also have my own website, pjsportsradio.com. We have live guests in studio, and we talk about discussions and topics that everyone wants to know locally here on the islands. We cover everything from surfing to basketball to whatever's going on locally, sports-wise. We try to do our best and cover the topics in depth as much as we can. Once again, thank you for joining PJ here on Hawaii Sports Update. Mahalo.
Hi, I'm Jay Fidel. That's Ted Ralston. You know, Ted is the host of Where the Road Leads. It shows every Friday from 4 to 5 p.m. It's about technology. It's about how people collaborating and solve problems with modern technology. It's where the road leads. We all know that. We should all be listening. Join us there, 4 to 5 p.m. every Friday. Now, what about that do you agree with?
All of it.
I knew he'd say that. Aloha. Say aloha.
Aloha.
Good.
Okay, we're back. Hi, I'm Chris Lethem. This is The Economy and You. Today's guest is Martin Zorn. Martin is from a corporation called Kamakura. Kamakura Corporation is a software company that helps institutions with all sorts of finance and risk management issues. And so we were talking about banks, Martin. So let's talk a little bit about insurance companies and some of the challenges that they face as an institution.
Sure. Insurance companies have the opposite challenge from banks. So banks, typically will raise their money short, deposits, and lend it out long. Insurance companies, if you take a life insurance company, I'll collect a premium from you today, and then I may not pay it out for 40, 50, or 60 years.
Right.
Even a property and casualty company, so you have an auto insurer, you pay your premium every year, but you're not going to have a car wreck the day you walk out of your insurance
decidedly
company's office.
that's generally not a good practice. Your premiums tend to go up a little.
Yeah. So the insurance companies have the opposite problems of banks.
Okay.
So the insurance companies have all of this money for which they don't have to pay out for a long period of time.
And they have also a lot of constraints that they have to follow with their
Correct.
investments.
Just like banks, they have to have minimum capital standards. Their liquidity issues are a little bit different because, again, a bank, if you have your checking account, you could write that check or come in and close your account at any time.
That's right. You have that option.
On the other hand, what insurance companies have to worry about is if there's a hurricane and they have to make payments for catastrophic payments. But for the most part, they can predict when the money will have to be paid out, and it's much longer. So the insurance companies really want to maximize the type of investments they make.
Right. But they're
to use the money.
But they're still constrained. They can only put so much into the equity markets. They have to maintain a certain amount of liquidity.
Right. They have to worry about liquidity. They have to worry about the credit quality of what they're investing in.
Yes.
And again, because it's long term, they're even more sensitive to some of the options, as we said.
Are they able to invest in hard assets more than, say, a bank would be?
In generally speaking, the answer is yes. What you find is that insurance companies, other than banks, will lend on different types of assets. So where a bank will typically lend more for working capital and shorter term purposes.
Okay.
What you find is insurance companies would have a much larger portfolio of, say, commercial real estate loan, long-term commercial real estate loans, because that better matches that long-term obligation that they have.
So, and of course, you have the risk profile associated with that. I mean, insurance companies have to maintain, I'm sure there's actuarial analysis that's done to ensure that they can meet their future liabilities based on predictive models.
That's correct. So, they have their actuarial models that are predicting when they'll have to pay out under their policies, and then you would typically have a chief investment officer that is looking to try to replicate or match those cash flows on the investment side to maximize the return while maintaining capital and while maintaining enough liquidity to meet both regulatory guidelines as well as any emergency payouts that they might need to make.
This all seems really technical. So when you're talking to clients, I suppose when you're talking to these investment houses and banks and insurance companies, they've got a lot of smart people around that really understand all of this. But what you're doing is giving them the tools to make their life easier. Is that?
Yeah, that's exactly right. So We have globally, we have a number of competitors. Most of our competitors are much larger than us. So what we've really done that differentiates ourselves has really been continuous innovation. A lot of technology companies have one good idea, and then they leverage that and end up selling out. Yes. And what has differentiated us is that our track record of continuous innovation, all of our development, I might add, is here in Honolulu.
Okay.
And this is kind of the brain trust, if you will, for our development. And when you take a look at what we've done, we're continuing to develop new models. So, last year we introduced a commercial real estate model because valuing commercial real estate assets and loans is different than residential real estate.
Well, and it's how do you determine fair value? One of the things that's challenging is there's lots of different ways to define what fair value is, depending on the scenario, macroeconomic conditions, liquidity requirement. It's all going to change, right? So when you're doing you have all these different models, then you've got all these different scenarios. Now the question is, how do you help to identify the appropriate scenario for an institution?
That's where, literally, when I talk about rocket science, as a number of the guys that we have here
yes.
that develop this are rocket scientists. I mean, our two of our senior developers, one is a PhD in physics, the other's a PhD in astrophysics, and using the same techniques that are used in physics, they've been able to apply that to what we do so that we're not bound by what has recently happened. If you went and asked somebody 6 months ago whether oil prices would be at $50 a barrel when it was at 120 and going up.
Yeah, exactly.
Nobody.
Who would have thought?
Exactly.
Right.
So those types of situations, when we get back to that Monte Carlo simulation I talked about, we produce literally hundreds of thousands of simulations every day on what will happen with the macro factors. We know things change. Interest rates change every day.
Right.
Oil prices change every day. Stock prices change every day. And based upon those, you have a different starting point when you run the simulation each morning.
And you have, of course, the thing is the amount of variables that are out there are just infinite. And of course, what you're trying to do is operate based on probabilities. I'm sure there's a lot of probability analysis. And people have to sort of find their own comfort zone within these probability statistics on how they want to operate, or if you're a pension fund, if you're running a money management firm and you have a conservative approach to money management, you're probably going to use models that are more conservative.
That's correct, and you can control that, and basically it's your appetite for risk,
yes.
which translates your appetite for loss.
So, but the problem, of course, is that your eyes are one place and your stomach is somewhere else.
Well, and that's where what we try to do is we try to take the emotion out of it and simply give people a quantitative solution that will say, here's the possible outcomes. I hate to kind of get technical, but one of the measures
well, so far we're doing great.
Well, one of the measures that traders use is a concept called VAR, or value at risk. And what that basically measures at a certain probability level is what your loss would be.
Okay.
So, people got comfortable in saying, I'll make up some numbers. I'll give a 99% VAR and your loss is $100,000. So basically 99% of the time your maximum loss would be $100,000.
Okay.
Well, if you hold a bond for a year, there's 365 days. So 1% risk basically means that you're going to exceed that loss 3 times in a year.
Or at least if you're looking at trading days, I don't know, maybe quite as many trading days, but yes,
Exactly.
Absolutely, yes. Okay, so there's going to be a couple of tough days.
Exactly. So, if we go back to 2007, before the credit crisis, what nobody asked was, what is my maximum loss on those 3 days when I've just broken my VAR?
Yes.
Instead, they looked at, I have a low VAR, it must be safe. So,
Yeah. That's so, by the way. That's so.
So from a statistical standpoint, that's what people call tail risk, or that, when people talk about black swans or fat tails, that's what they were talking about.
Okay, all right.
Is that, you have that bell curve that everybody's used to looking at and saying that's normal distribution, but
Yeah.
but things aren't normally distributed. So, what a simulation model does, it lets you see all of the possible outcomes. So what we do is we give people that added information of not just what's the 99% probability of a loss, but we let them see what those worst case losses are.
Okay, because I don't know if you remember back in the 90s, George Soros, he did a little thing where he collapsed the currency of several South Asian countries, Indonesia, Malaysia. I believe Singapore was impacted by that as well, Burma. And of course, this all had to do with these countries unable to support the valuation of the currency. This was, of course, I know I was living in Indonesia, and the rupiah went from 2,500 rupiah to the dollar to something like 15,000 rupiah to the dollar. So the rupiah lost, 80% of its value. And of course, here is a scenario of where you could put money in the bank and you were getting 25% return, but nobody ever thought that the currency itself would actually collapse to that point. So I think these are the kinds of things that sounds like what you're doing is you just come up with all these different scenarios continuously.
We have to, because
Yeah.
the correlations, you mentioned earlier that we did a lot of correlations, and we do, but correlations are not fixed. I like to say things are correlated until they're not. And conversely, when you have a crisis, everyone's correlation goes to 1, which is why nobody was able to sell anything back in 2008 and 9, because all the markets locked up.
Yes. And of
So-
course, then you had a liquidity issue.
Exactly.
Right, okay, because then everybody's trying to sell, nobody wants to buy.
Right.
And the market makers, of course, are not answering the phone. In the market, there's always supposed to be an entity that is, if nobody else is willing to buy your security, they'll buy the security, except that actually there are days when they don't pick up the phone.
That's exactly right, unless it's cash.
Yes.
And another example of where, and again, the models have to be dynamic. Because another example is what we're seeing right now with interest rates, is that...
It's unprecedented, isn't it? I mean, I find that interest rates are so incredibly low and so flat.
Well, actually, in half of the European countries, they're negative.
See, that's just amazing that we could actually be at a place where we have negative interest rates. That means basically you're not earning any money. In fact, you're losing money by lending your money out to these other institutions.
Exactly. What people are saying is that, I don't want to stick the money under the mattress because somebody may rob me. So I will go and give you $1 because I trust you so much, Chris. I'll take 95 cents back in a year, and I'll feel good about it.
Yeah, that's amazing. That's absolutely amazing. Of course, that's actually an issue of interest versus inflation rate, right? So that's how you get to a negative value, is because inflation actually exceeds the amount of earnings.
Yeah,
on the
so
money. Is that kind of in the real world?
When people look at real interest rates, you take what you earn, less the inflation rate.
Right.
But with negative interest rates, even at zero inflation, that you're
still losing money. Yeah, you're
exactly.
losing money.
And that's where people worry about the deflationary pressure, because in a deflationary environment, everything will be worth less in the future. So if you have a deflationary rate that's less than your interest rates, maybe a negative interest rate, you'll still be okay a year from now.
Wow, that's amazing. Well, I'm Chris Lethem. This is The Economy and You. Our guest today is Martin Zorn, and stay tuned. We'll be back with more exciting technical information about what's going on with risk management. Aloha.
Okay, this is Think Tech Hawaii, and it's Wednesday. Every Wednesday is Energy Wednesday here in Hawaii, the state of clean energy. 4 to 5 p.m. every Wednesday. Come and listen to us. And just to show you what I mean, I'm going to ask Sharon to tell us more.
Come and see us every Wednesday, as Jay said. And we have people like Jim Albers from HECO. here and co-host Ray Starling here every Wednesday. We not only go on Olelo and OC16, but also stream live. So please come visit us, hear about the latest in clean energy.
Okay, Jim, you've been here. You got any comment on all this?
As important as energy is in all of our lives today, this is a great forum and a great format to vet those issues. So I encourage everybody to listen in and participate.
Okay, Ray, what do you think for a close?
Well, I think this is the greatest show in the energy world here in Hawaii. You can come here every week, 1 hour, and catch the latest on what's happening and hear from the people who really know what's going on, like Jim Alberts. We appreciate your coming today.
Thank you.
Ray Starling, Sharon Moriwaki, Jim Alberts, and Jay Fidel here in Hawaii, the state of clean energy, 4 to 5 p.m. Wednesday. Aloha.
Aloha.
Hi, welcome back. I'm Chris Lethem. This is The Economy and You. Our guest today is Martin Zorn, and we're talking about risk management. And he's from Kamakura Corporation. They are a software company that provides software for institutions to help them manage risk related to interest rates, liquidity, and various financial issues and instruments. So we're having a pretty technical but an interesting conversation. And so, Martin, one of the things we're looking at now in Europe is that interest rates are in negative territory. Warren Buffett, as you said, Warren Buffett is now running over there to do a bond issuance because you're actually getting paid to borrow money. It's absolutely crazy. Okay, so tell us a little more about what's going on you see in this arena at this point.
You know, right now, obviously, what's been driving it is reduced levels of interest rates, trying, on the one hand, to stimulate the economies. Mm-hmm. At the same time, you've got oversupply of so many commodities and other things forcing pricing down. So that's the fear of the
because
deflation.
we've not only seen oil come down, we've seen the prices of commodities across the board come down. There's a slowing of production and manufacturing in China.
China is slowing that.
Mm-hmm.
If you take a look at iron ore prices, if you take a look at just about all of the manufacturing commodities right now, they're at a much lower price than they were a year ago.
See, that's amazing. I just find that's amazing. We talk about the United States and our economy is growing, although it's not growing at the pace we would like to have it growing. We still have a growing economy, but apparently there's a slowdown in other parts of the world. And this is causing chaos. Of course, we're seeing the dollar climb because even as low as our interest rates are, they're still better than rates in other parts of the world.
No, correct. We actually have, fairly high rates compared to other, industrialized countries. In fact, compared to the Bund, we were about 170 basis points or 1.7% higher, which strengthens the dollar. It's great for American consumers because we're an importing nation, but it's hard for American exporters.
Right, that's true, that's true. Now, of course, if you're an investor and you're looking at valuations, you've seen the dollar go up, you might think it might be a good time to start looking around at other places in the world where currencies, Russia, in fact, of course, had a collapse of the ruble.
Yep.
If you want to take a little risk, maybe with a little part of your portfolio, you might start looking at those areas and see if there's anything that gets you excited.
I would be very selective in terms of the sovereign risk, which we haven't talked about in these various countries. Because,
That's true.
One thing that people have to remember, and we say this a lot, because one of the other models we have is a sovereign risk model, is that corporations default because they have to. Governments default because they want to. So they could default in a couple ways. They could just say, like Greeks have done, is saying, I don't want to pay back what I owe you, is give me a discount.
Right.
The other way that governments default is they print more money and devalue their currency.
Now, is that what we've seen? Is we've seen a printing of money, or have we just seen a lackluster interest in?
Well, I think we've seen a little bit of everything. If you go country by country, in some cases it's been they're printing more money to devalue it. But, obviously a devalued currency supports the exporters in that country.
That's right, that's right.
Even here in Hawaii, we've got to worry about interest rates because, again, when we take a look at where our tourists come from, they've got to convert their local currency into dollars. So a strong dollar hurts our tourist economy.
Mitigates our our opportunity to have tourists come over here. Of course, that means they're going to make a larger commitment to the amount of money they're going to spend on holiday.
Exactly. And
Yes.
if they are going to come, if the Australian dollar is a good example of another currency that's devalued against the dollar. If Australian tourists was spending $200 a day a year ago, they might can only spend $100 a day here now, and it costs them the same in their local Australian dollar.
That's right. That's right. Now, another thing that concerns me is that there was an act, I think it was Act 100. This was back a few years ago, where Senator Hanabusa and Governor Cayetano at the time diminished the amount of money being put into the retirement, the employee state retirement system. Of course, that's had an impact now. We have a $3 billion deficit that we need to make up, I think, over the next 6 years. I think there's some sort of a federal mandate that requires us to refund that now. Okay, so my concern is with that, obviously, is if there was a collapse in our stock market at this point, we have a $3 billion deficit right now. But if we had a collapse like we did back in 08 or 09, the concern is what kind of liability would that create for us going forward?
Yeah, bringing up pension valuation is very interesting, and we have a lot of interest in it. Again, with our models, or what we call econometric models. So we're taking a look at basically future cash flows that are discounted by an interest rate. When the shortfalls are measured on pensions, are done actuarially, which is done a little bit differently. And we have talked to a number of people about the need not only to have their actuarial shortfalls, but to do an econometric measurement of where their pensions stand. Because again, from the standpoint of the pension, there's a couple things. There's the obligation.
That's right.
To the current and past employees, and that's going to grow based upon the pension plan itself.
And plus, there's the the experiential component, and of course for Hawaii, the actuarial tables that are set up are based on national standards. Hawaii, we tend to live a little bit longer than the rest of the country, so those actuarial assumptions may not hold true, which means that we may even be more underfunded than we think that we are.
That is very true. Additionally, there is the assumptions you make of how long your employer is going to work.
That's true.
Offsetting it, if people work longer, they're paying more into the pension plan. And then there's what your level of future state employment will be, because if your employment is falling, then you have less people that are paying into the plan and more people withdrawing from the plan. So that's another factor that gets into that econometric measurement.
So
and then, of course,
so then it kind of makes it hard where you can or justify reducing the size of the employee base, government employee base. You maybe are less apt to do so for fear that it may have a negative consequence down the road.
It depends on how the plan is structured.
Okay, all right.
If the plan is structured where a state is paying all of it, then that may be a totally different decision than if it's structured in a way where the employees are contributing to part of it.
I see. Okay, so like with a profit sharing plan versus a defined benefit plan.
Right.
With profit sharing plans, maybe the organization, such as the state, and the participant themselves are both contributing toward under a 401k plan, which is a type of retirement profit sharing plan. And then you got a defined benefit plan, of course, which is generally always funded by the employer. In this case, would be the state.
Right, and furthermore, what you have when you think about the number of employees you have, they're also paying taxes as well.
That's right. That's right.
So that's part of the revenue side of it, and then you have the investment side. There's a lot of debate about what you should use as the proper way to discount those future obligations. A lot of pension plans just use 7% as a long-term stock market return.
Right. Now, I understand, from what I understand, the state uses an 8% growth assumption, which is a bit of an aggressive assumption. But by using an aggressive assumption like that, that means you can either justify putting less money in, okay, assuming that you're going to make more return on it. But again, if you're too aggressive, then you're going to have an unfunded, even a larger unfunded liability.
Yeah, that's correct. Or what you do is that you're investing your money in much riskier types of investments to try to chase that return.
To try to chase that return. Of course, again, in 2008, 2009, we experienced the downside of that.
Right, which, there's another academic view that says that you should really use a risk-free rate as a discount rate, because when somebody retires, they're expecting to get paid back.
And that's essentially the window rate on money, like the current, like T-bill, what you would get on a T-bill.
Right, in terms of, guaranteeing that a dollar of future obligations worth $1, that not in a year. Nobody wants to be the guy that retires in the year that the stock market goes down by 20%.
Absolutely not.
and there's some other states doing some really risky stuff. I think it was, I'm going to be somewhat at risk. I want to say it may have been Kansas, but it was one of the Midwestern states that was actually talking about borrowing money because rates are so low, to invest it in the market as a way to minimize their pension obligations now.
Okay, well then that gets into a whole can of worms, doesn't it?
Absolutely.
It kind of sounds like what the Fed's been doing is they've been buying money, they've been buying bonds, and then of course at some point they're going to issue those bonds back into the market, or they're just going to hold. I'm not even sure what's going to happen with all the bonds that the Fed's been buying over these last couple of years.
Of course, a lot of those bonds are issued by the government. So.
Yes. So it's like the government paying itself. It's pretty amazing. This has really been an interesting conversation with you, Martin. I'm so glad you came onto the show today, because it's although it's a little bit more technical, I think it's really been instructional in terms of understanding a lot of the thought process that goes into governance. When you're managing money and you're doing bonds and you're doing revenue bonds and geo bonds like in the government, and then trying to understand that there are risks associated with borrowing money.
Absolutely.
And then of course we need to manage our money well and be prudent about our investments and make sure that we do mitigate our risk.
Yep, and the risks come in a lot of different forms. So you've got systemic risk or market risks.
Right.
Is that if you're borrowing money, that we don't control what happens to foreign exchange, but we're impacted by it.
That's right, we are.
That you've got interest rate risks that you could look out somewhat in the future, but we're both old enough that we remember double-digit interest rates.
I'm not that old.
And
so this is called Advanced Financial Risk Management, the second edition. Now, this was a book?
This is a book that the three authors of it are Don Van Devender, who's our founder, Ken Giamai, who is our head of development, and Mark Messler, who is our product manager for our default probability service.
Okay, so who would be the best people to read that book? Who should be reading this book?
I would probably say that it should be risk managers, portfolio managers, but it should also be the boards of directors of those companies that either manage money, invest money, or borrow money.
Okay, very good.
Because the best management of risk is if you've got a informed oversight process.
Okay, very good. Well, thank you very much, Martin, for coming on the show today. It's been really educational, and fun having you on the show today. So, I'm Chris Lethem. Today's guest was Martin Zorn from Kamakura Corporation. They are a software company located here in Honolulu. And thank you for watching, and we'll see you next week, Wednesday at 3 o'clock. Aloha.